If you're in your 20s or 30s, retirement may not be at the front line of your mind if you're just starting out your career. You may be juggling to make ends meet or just get by with your starting salary. Keep watching this video to find out more about 5 assets everyone should have in their 20s and 30s. Accept your employer's generosity. Some employers give you money just for saving for retirement through 401k plans. A 401k is a tax-advantaged retirement account, which means you can contribute directly from your paycheck pre-tax. Employers that offer this benefit often also match contributions up to a certain percentage of your salary. If your company offers a match, think about contributing enough to get the maximum, or work your way up to that. If a 401k isn't an option, or you're already earning a match, see if you meet the income requirements for a Roth IRA. Unlike a traditional IRA or 401k, it won't give you a tax break on contributions, but it offers something potentially better. You won't pay federal taxes when you pull money out in retirement. That's right, your contributions and investment earnings grow tax-free. One other note here, some companies offer a Roth version of the 401k. If yours is one of them, you may want to take advantage. The payoff. Want $1 million? Let's say you earn $35,000 a year and your employer matches half of your 401k contributions, up to 6% of your total salary. If you contribute 6% beginning at age 22, you'll have over $1.2 million by 65. Assuming a 7% return and annual salary increases of 3%. Without that employer match, you'd just have $800,000. And without contributions to a 401k, you'd have zero, of course. Keep it simple with index funds or ETFs. One good way to invest in stocks or bonds is through index funds or exchange-traded funds. These funds hold pieces of many investments, and they're designed to mimic the performance of an index. An index tracks the performance of a portion of the stock market. For example, the S&P 500 tracks 500 of the largest companies in the US. Instead of buying the stocks of all those companies, or even buying individual stocks period, which takes more time and research than most of us want to commit, you can buy into an S&P 500 index fund that holds shares of those stocks. The idea is to invest in several of these funds within your 401k or IRA to build a diversified portfolio that includes US stocks, international stocks, and a small allocation of bonds. For each fund, you'll pay an expense ratio, which covers the cost of running the fund. A 401k will have a small, curated list of fund choices. In general, you can decide between 2 funds in a category. An example of a category would be US large cap or large company stocks, by going with the one with the lowest expenses. A tough roadblock for new IRA investors are fund minimums, where funds require minimum investments of $1,000 or more. A 401k allows you to avoid that. An IRA workaround, ETFs don't have minimum investment requirements. These funds trade like a stock throughout the day and are purchased for a share price, which for some funds can be as low as $50. That can get you in the door of several ETFs for very little money. Here are NerdWallet's best brokers for ETFs. Not to question your stock picking skills, but researching, selecting, and managing individual stocks is challenging. Even the pros can screw this up. Going with index funds could easily save you a few hours a week. Get help managing your money. An index fund makes investing easier, but if you still need help, you're lucky to be living in an age where you can get it for cheap. With a 401k, that help is typically available through a target date fund. This type of fund adjusts to take less risk as you age. You can pick one by using the date in its name, which is supposed to line up as closely as possible to when you plan to retire. So if you're now 25, for example, you'd add around 40 years and pick a fund tagged 2055 or 2060. You'll generally pay higher expenses in a target date fund, but some investors find the simplicity is worth it. Keep in mind that you can always swap to a different fund later. If you're investing in an IRA, you could open that account with a robo-advisor, which is a computer-based investment management company. These companies charge a percentage of your account balance for their services and investing tips. Many big players such as Wealthfront and Betterment cost less than 0.50%, and that includes investment expenses and management fees. The payoff? A little oversight and a buffer against your own mistakes, which could be well worth it. Education. Education is probably one of the best and most lucrative investments you can make for yourself. You are the vessel that you will take on this journey through life. It isn't some investment, stock, or business. This doesn't mean you need a degree or professional qualification to be successful. This means having an awareness to continue learning, reading, and continuing your knowledge growth for many years to come, even after you have left school. It could be simple things like reading books, watching documentaries, attending seminars, conferences, etc. The payoff is a lifelong gift that keeps on giving. Education is the way forward. You can not only change your own life, improve your quality of life, or be working for a higher wage, but you can provide all these same things for your next generation too. If you're in your 20s or 30s and wondering when to start investing, the answer is now. The longer you delay and put it off, the lower your investment compounds and the fewer risks you're able to take later on in life.